All right, something violent just happened in the silver market, and it didn't happen slowly. In a matter of days, Western silver collapsed from around $121 an ounce to roughly 85. That's a 37% wipeout, 37%. And while Western investors were dumping contracts, new reports hit that China is stepping in and buying billions of dollars worth of gold and silver right now. Here's the part that should snap you awake. Silver in the West is near 85, while Shanghai silver never broke and is still trading around 122. That's a 40+% premium. Stay with me, because I'm going to show you why this didn't happen for the reason most people think, and how you can recognize this pattern the next time it shows up. Before I explain what caused this crash, let me teach you something most people never really internalize about markets. Price is not just supply and demand. Price is stress. It's leverage. It's who's forced to act right now versus who can wait. Think of it like a crowded theater with a narrow exit. If everyone calmly walks out, nothing dramatic happens. But if someone yells fire, the exit price skyrockets because people are forced to move at the same time. In markets, paper contracts are that crowd. Physical metal is the building itself. Most people look at the price drop and assume demand collapsed. But demand and price are not the same thing when leverage is involved. That misunderstanding is where opportunity usually hides. So what does that tell us? It tells us you need to look at who's being forced to move. When you see a massive price drop like this, your first question shouldn't be what's wrong with silver. Your first question should be who needed cash right now? Who was over-leveraged? Who couldn't hold their position? Because when forced sellers dominate the market, price becomes a function of their desperation, not the value of the asset. And that creates these weird disconnects between paper markets and physical markets. That's exactly what we're seeing today. If this is making sense, drop a comment below and let me know where you're watching from. I want to know if you've been following silver or if this is new territory for you. Now let me show you what's actually happening under the hood. Let me break down the sequence in plain language. Silver had been running hot. Futures positions were crowded. Margin levels were high. Then volatility hit. And when volatility hits leveraged paper markets, brokers don't ask politely. They issue margin calls. So when silver started slipping, leveraged traders were forced to sell, not because they wanted out, but because they had no choice. That selling pushes price lower, which triggers more margin calls, which forces more selling. It's a cascade. That's your primary driver here. Now let me walk you through exactly how this cascade works, because understanding this is critical. Let's say you're a fund holding silver futures contracts. You put up maybe 10 or 15% margin to control a large position. Silver's at 120, you're feeling good, everything's working. Then something changes. Maybe it's macro fear. Maybe it's liquidation in another market. Doesn't really matter. Silver drops to 115. That's only 4%, right? Not a big deal. Except when you're leveraged 10 to 1, that 4% move against you just wiped out 40% of your margin. Now your broker calls and says you need to wire more cash by tomorrow morning or we're closing your position. But here's the problem. You don't have extra cash sitting around. You're already deployed, so you have two choices. Sell something else to raise cash or let them liquidate your silver position. Either way, you're selling. And you're not the only one in this situation. There are hundreds of funds, thousands of traders, all getting the same margin call at roughly the same time. So what happens next? They start selling. And because they're all forced sellers, they're not waiting for a good price. They're hitting bids. They're taking whatever the market will give them because they have no choice. That drives silver from 115 to 110, then to 105, then to 100. And every tick lower triggers another wave of margin calls on the next group of traders who were slightly less leveraged. It's a domino effect. This is what people mean when they talk about a liquidation cascade. It's not organic selling based on fundamentals. It's mechanical selling based on leverage and forced liquidation. But here's the part that should make you pay attention. While this is happening in Western paper markets, something completely different is happening in the physical market. The secondary confirmation is the split you're seeing right now. Western paper silver trades around 85, but physical demand in Shanghai never collapsed. In fact, Shanghai prices stayed near 122. That's not a coincidence. That's not a glitch in the data. That's proof the sell-off wasn't about too much silver. It was about too much leverage. Let me explain why this matters. If the fundamental demand for silver had actually collapsed, you'd see Shanghai prices collapse too. You'd see physical premiums shrink. You'd see dealers desperate to move inventory. But that's not what's happening. Shanghai's holding firm. Physical premiums in the West are actually expanding. Dealers are reporting tight supply on certain products. What does that tell you? It tells you the paper market and the physical market are temporarily disconnected. And here's what's wild about this. While Western funds were liquidating paper to survive, China stepped in and converted that paper weakness into real metal. They didn't chase price higher. They waited for forced selling. Then they bought size. Now let me show you what most people are missing. When paper selling exhausts and physical demand never breaks, price discovery eventually snaps back toward the real market. That's the tension building right now. You've got Western paper markets saying silver's worth 85. You've got Eastern physical markets saying it's worth 122. One of those prices is lying, and historically it's not the physical market that's lying. Physical markets can't fake demand. You either want the metal or you don't. Paper markets can fake price for a while because leverage amplifies movement in both directions. But eventually, if people keep wanting physical and physical supply tightens, paper price has to reconnect with reality. That's the setup we're watching right now. This is the exact same playbook we've seen before. Zoom out with me for a second. In 2008, precious metals were smashed during the financial crisis as funds sold anything liquid. Gold dropped from over $1,000 to below $700. Silver got crushed even harder. People were calling it the end of the precious metals bull market. But you know what happened beneath the surface? Physical demand stayed firm. Strong hands accumulated. Central banks in Asia kept buying. And what followed? Silver staged a violent recovery from $9 in late 2008 to nearly $50 by 2011. That's a 500% move. It didn't happen because fundamentals suddenly improved. It happened because forced selling exhausted, and the fundamental picture never actually broke. Fast forward to 2020. During the global shutdown panic in March, gold and silver were dumped to meet margin calls. Funds needed cash. Everything got sold. Silver dropped from over $18 to under $12 in a matter of weeks. And once again, people said the precious metals trade was dead. But what happened? China increased imports. Physical premiums exploded. Dealers couldn't keep product in stock. The US Mint ran out of silver eagles. And by August of that same year, silver was back above $29. What followed wasn't calm, it was volatile. But prices recovered hard once forced selling ended. Every time this pattern appears, it looks terrifying in the moment and obvious in hindsight. The larger story is that paper markets can temporarily lie, but physical markets eventually force the truth. And I'm showing you these examples not to predict the future, but to show you the pattern. Leverage-driven sell-offs create violent drops that look fundamental but aren't. Physical demand staying firm while paper sells off creates the setup for violent recoveries. It's the same script running again. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep going lower? Yes. Volatility cuts both ways. If we get another macro shock, if there's forced selling in equities or bonds, funds might need to liquidate metals again to raise cash. Could that push silver down to 70 or 60? It's possible. Could macro stress force another wave of liquidation? Absolutely. And here's the thing about manipulation claims. You don't need a villain to explain this move. You don't need shadowy forces or conspiracy theories. Leverage alone is enough. When you've got futures markets trading 10 to 20 times the amount of physical silver that actually exists, and when margin requirements are low, these cascades are built into the structure of the market. It's not manipulation, it's mechanics. The actionable takeaway isn't blaming the system, or getting angry at market makers or central banks. It's understanding the mechanics so you don't panic at the wrong time. It's recognizing when a move is mechanical versus fundamental. Focus on what you can control. Price levels, spreads between paper and physical, behavior across different markets. Those are your signals. The rest is noise. There are probably 3 types of people watching this right now. Let me talk to each of you for a second. If you're short-term focused, maybe you're a trader. Maybe you're asking, is this the bottom? Should I buy here? Let me be honest with you. Exact bottoms are guesses. I don't care how good your technical analysis is. I don't care how many indicators you're running. Nobody rings a bell at the bottom. What matters is whether 80 to 85 holds and whether Shanghai stays above 115. That's your signal set. If Western paper breaks below 80 and Shanghai starts dropping toward parity, that would suggest the physical market is cracking too, and you'd want to be cautious. But if Western paper holds 85 and Shanghai holds 115 or higher, and that premium stays wide, that tells you the dislocation is still mechanical. For you, the trade isn't about calling the exact low. It's about recognizing when risk-reward shifts in your favor. And right now, with paper at 85 and physical proving it's still wanted at 120, that's a pretty compelling setup if you can handle volatility. If you're a long-term stacker, someone who's been buying physical for years, this volatility shouldn't scare you. It should validate why physical ownership matters when paper breaks. You're not trading contracts, you're holding metal. And what you're seeing right now is exactly why that strategy exists. When paper markets panic, physical markets show you what real demand looks like. Your job isn't to time every swing. Your job is to recognize that these dislocations happen, and they create opportunities to add if you've got dry powder. Don't chase. Don't panic buy. But if you've been waiting for a better entry, or you want to add to a position you already believe in, moments like this are what you've been waiting for. Just make sure you're buying actual physical, not paper exposure. That's the whole point. And if you're newer to this space, feeling overwhelmed trying to make sense of all this, that's completely normal. You're watching a 37% crash in days while hearing that China's buying and physical markets are holding firm. That's confusing. It feels contradictory. But here's what I want you to understand. Your job isn't to predict next week. It's to recognize when a move is mechanical, not fundamental. That skill compounds over time. The more you watch these patterns, the more you start to see the structure behind the chaos, and that's what separates people who panic at bottoms from people who recognize opportunity. You're building that skill right now just by watching this and thinking critically about what's actually happening versus what it looks like on the surface. So here's what I want you to answer in the comments. Which type are you? Are you trading this, stacking this, or just learning? And what's your biggest question about what we're seeing right now? I read every comment and I want to know what's on your mind. Here's where I stand. I'm not euphoric and I'm not panicking. I'm analytical. Let me tell you what I'm personally watching. First, I'm watching whether Western silver holds that 80 to 85 zone. If it breaks below 80 with conviction, that would suggest more forced selling is coming or that physical demand is starting to crack. But if it holds, especially with high volume at these levels, that would indicate forced sellers are exhausting and buyers are stepping in. Second, I'm watching Shanghai prices. If they stay elevated above 115, that confirms the physical market never broke. If they start falling toward Western prices, that would tell me physical demand is weakening and the premium was temporary. Third, I'm monitoring whether the premium stays above 25%. A sustained premium of that size is unusual. It's telling you there's a structural dislocation between where paper trades and where physical clears. If that premium holds or widens, it's a strong signal. If it collapses, it means the markets are reconnecting and the dislocation was brief. Based on my analysis, this crash was structural and mechanical, not a collapse in demand. The fundamental picture didn't break. It flashed a signal. You had overleveraged paper positions getting liquidated while physical demand stayed firm. That's a classic setup. The fundamentals that drove silver higher in the first place, supply deficits, industrial demand, monetary concerns, those didn't change in the last week. What changed was leverage got flushed out of the system. And historically, when leverage gets flushed and fundamentals stay intact, the asset recovers. It might not happen tomorrow. It might take weeks or months. And it'll probably be volatile the whole way. But if history rhymes and physical demand holds firm while forced selling fades, the move that follows could be just as violent as the drop, maybe more. I'm not a financial advisor. This is not financial advice. I'm sharing my perspective on what I'm seeing in the market and how I'm interpreting the data. Do your own research. Make your own decisions. Think for yourself. If you made it this far, you're the type of person who doesn't just react to headlines. You want to understand what's actually happening. That mentality will serve you well. While most people are panicking or celebrating without understanding why, you're building the skill to recognize patterns and think critically about market structure. That's how you avoid getting wrecked by volatility and start recognizing opportunity when it shows up. If you found this valuable, share it with someone who's trying to make sense of what's happening in metals right now. Subscribe if you want more breakdowns like this, and drop a comment with your thoughts. I want to know what you're seeing and what questions you've got. Stay sharp out there. Think critically, verify the data, and make your own decisions.